Hello everyone, welcome back to my channel, and today we are going to do IPO analysis. So this IPO is of SEDEMAC company, which will be opening tomorrow. mm, to be specific, on the 4th of March 2026. So let's begin. So, SEDEMAC company, this issue is entirely offer for sale issue, no fresh issue or anything. So, for this issue, the IPO size is given and the price band is around 1,287 to 1,352. The lot size is 11 shares. So, if you are going to buy one lot, you will get 11 shares with it in it. So this company is being listed on both BSE and NSE. The listing date is 11th of March. The face value is 10. Now the quota percentage that we will be getting. So for retail investors, minimum like you are get 35% of the net offer is going to go to the retail individual investors, the people like us. So 35%, it can be 35 or more than 35, but not less than 35. And then 50%, not more than 50% of the total share is going to go to QIVs. And then at least 15% is going to go to non-institutional bidders. 50% or 50% से ज़्यादा भी हो सकता है. Next, now as this issue is entirely offer for sale issue, why are these? We need to understand one thing, that why are these large institutional funds offloading significant stakes in this company? So if you see, the promoters are barely selling anything, but there are four big institutional investors that are selling almost 98% of the IPO shares. So should you be worried about this? We'll see. So first fund is the A91 Partners. So they invested in this company at around 2021, and their cost at that time was 368 rupees per share. But now the IPO is getting listed at 1,352. So that's nearly around 267% of returns in 4 years. But there is one catch, that they're only selling 30% of their stake. Now, why are they doing this? Maybe because they want real cash returns to their investors. So we can consider this as a planned partial exit and not a panic selling. Next is NRJ and Family Trust. So this, they entered at around 94 rupees at, I don't know the year, but yeah, they entered at 94 rupees. Means they're going to get over 1,300 percentage of gains through this. And they're also selling about 30%. So why 30%? The significance of this 30%, we'll understand this later. Let's complete with these four institutional buyers, sellers. So there might be two reasons. So first is massive profit booking, and other is to create enough public float for listing. You need to remember one thing, that is this IPO has no fresh issue. So someone has to sell their shares for the IPO to happen. So maybe they are doing it. Next is exponential funds. So exponential funds opportunities actually targets around 3x to 5x returns in 3 to 5 years. Now, the IPO valuation, this IPO valuation hits their internal targets. So they're simply locking in the gains and exiting, not completely, or obviously 30%, but yes. Next is 361 funds. So these funds run a pre-IPO fund. So technically their job is like they invest before IPO, exit at when the IPO is listed, and gives liquidity to the client. Now, selling here is literally their business model. So it is their job. They have to do it. So understanding these reasons, by understanding these reasons, the real question here is, should you be worried about it? If the company was bad, would all the investors only be selling 30%, or would they dump entire 100%? But what I feel is they're taking off money from the table, but keeping 70% invested, and that's important. Now, why let's so the fact that they are selling exactly 30% of their stakes is given by the MD of the company. The statement is given by the MD of the company. So why 30%? There might be many reasons, but two of the reasons that I found valid, or I found is important, is first, the if the investors sold around 100%, the company would the public would think something is wrong with the company. So obviously not 100%. So if they sold 0%, there wouldn't be enough shares for public to buy. That is low amount of free floating shares. So 30% is a Goldilocks zone. So what is Goldilocks zone? That we learn later on. But for now, we can say a sweet spot. It provides enough shares for the IPO to have in free float, but also shows that the big funds still believe and still have 70% of their future invested in this company. Another might be that, so by selling their 30% of their shares at a valuation of 6,000 crores, most of these funds are essentially recovering their initial investment plus a profit. So this makes the remaining 70% free shares for them, which they can hold for years without any risk, without any loss. Now, beyond the standard fund life cycle reasons, there might be some other reasons or pressures or opportunities driving these specific sellers. So, what are those? First, it might be the accounting mirage exits. So, let me explain it to you. The timing of the profit after tax spike. So, if you look at the financials, SEDEMAC's profit jumped from 5.88 crores in FY 2024 to 47.05 crores. Now, the managing director admitted that this explosion in profit was largely an accounting effect. So what happened before May 2024, the company had preference shares that were counted as liabilities. Once converted into equity, that cost of paying dividends, suppose, disappeared. So this made the profits look bigger overnight. Now, what is the institutional investors' logic behind this? That they know that the spike is one time accounting boost. So they are selling now because the company looks much more profitable than it was a year ago. This allows them to command a higher IPO price. Apart from this, the customer concentration fear. So one of the major customer, TVS Motor Company, contributes nearly 75% of the SEDEMAX revenue. So for a fund like A91 Partners or 361, having 75% of your eggs in one basket is a massive risk. So if TVS decides to develop its own ECUs or switches to competitors like anything else, then SEDEMAX value would crash. So selling a 30% stake now is a way for these funds to insure themselves against the future fallout from their customers, with their customers. Now, the EV angle of the company, that is another risk. So, SEDEMAC is a leader in ICE engine controllers. While they are actually moving into EV, their current bread and butter is still traditional engines. Now, the current two-wheeler or three-wheeler market is increasing rapidly with projected around 25 to 30% penetration by 2030. Now, investors like Exponential and Energy Trust might be worried that while SEDEMAC is EV ready, the competition in the EV space is much fiercer than in their niche ICE market that they currently dominate. So they might be taking money off the table while their ICE based dominance is still there in the market. Next reason might be the high caliber cost. So the company's core moat is its 150 plus engineers from IITs and NITs. Now, to keep these engineers from leaving for a high paying big tech or EV startup, SEDEMAC has to pay the top tier salaries. Now, this input cost is rising. Investors see that maintaining a technology led business is becoming more expensive, which might in future reduce the profit margins. So selling now captures the value before these costs fully hit the bottom line. It's as simple as that. Next, let's understand the business. So let's understand it from the basic question. What does the company actually do? Now imagine that you're at a traffic light on a scooter. Now when it turns green, you twist the throttle and the engine starts silently and instantly. No loud noise. It does not make any loud noise. So what SEDMAC does, SEDMAC makes the brains called as ECUs that makes this happen. They create the smart controllers for two-wheelers and three-wheelers. This is one of the market. They also lead the market in controllers for power generators, gensets, the boxes that manage how a generator runs. Is it easy to understand? Yes. Think of it as like software plus electronic company for machines. Instead of making like a heavy metal parts of an engine, they just make small computer chips and softwares that tells the engine on how to work efficiently so that they could save fuel or reduce pollution or etc etc. Next question is it scalable? Absolutely. Because they design the software and hardware themselves, and they can copy paste that technology across different industries. Like for example, the same technology they use for TVS Jupiter can be tweaked a little bit, and it can be used for an electric bike, or even okay, electric bike, let's say an electric bike. So they don't need to build massive new factories for new product. They just need more of smart engineers to write codes, nothing else. What is industry growth rate? So the world is technically moving towards smart and electric machines. So the market for the main product, ISG, is expected to grow at around 13 to 15% every year until 2031. Now, as India moves towards stricter pollution norms, and because of that, every vehicle needs more brains, like the ones that SEDEMAC makes. So even if the number of bikes sold stays the same, SEDEMAC makes more money per bike. Now, what is the competitive advantage, the moat of the company? So, most companies use physical sensors to track a motor. What SEDEMAC does is SEDEMAC uses complex math to do it without sensors. This makes the product cheaper and more reliable. So, this is one of their moat, and another is over 150 of their engineers are from top colleges like IITs and NITs. And this high level of brain power is very hard for a new competitor to replicate. So, this is the moat of the company. Now, next is the business cyclical or a stable business? I feel that it is a bit of both, since like 80% of their money comes from auto sector. If people stop buying bikes, their sales could drop. Now, their industrial businesses like generator is more stable. Plus, they have like 75% of the market share in India for generator controllers. So they are like kind of default choice in that company in that industry. So I feel it is a bit of both. But while understanding business, you need to understand if the market falls by like 30%, can this company survive? So to see if a company can survive a 30% market fall, we need to look at its debt to equity ratio. Now, SEDEMAC's debt to equity ratio is around 0.21 as of March 2025, and its debt is decreasing year by year. So good for us. But why do we have to look at debt to equity? Now let's imagine two scenarios, like one person A, another person B. So person A has a high home loan. The bank doesn't care if their income fell, they just want full EMI payment every month. So if a person A can't pay the bank takes the house. Now there is another person, person B, who has low debt. Now person B owns their home fully. When their income falls, they just eat out less and live a simpler life. So no one can kick them out of their house. So in a business context, debt is a fixed bill. Equity is an optional bill. So during a crash, a low debt to equity ratio means the company doesn't have a bully, or the bully, your bully is the bank, knocking on its door when the times are tough. Now let's do financial analysis of minimum like last 3 years. So first up, revenue. Is it consistent? So in 2023, they had around 429. In 2024, 535, and in 2025, 658. Now the 3-year CAGR is around 24 to 25% here. For for context, the Indian two-wheeler market grew at a 3% CAGR in the same period, and SEDEMAC is growing 8x faster than the industry. Why is this happening? Because vehicles are getting smarter, even if the bike sales are flat. The electronics inside them are increasing. That is why. Now, so it is a good, I will say, a thumbs up for from the point of view of revenue. Moving on, net profitability. So let's talk about profit, and this is actually where it gets interesting. First, let's talk about EBITDA margins. So their operating margins, that is EBITDA, has improved beautifully from 12.8% in 2023 to 19% in 2025. This shows that they are getting more and more efficient as they scale. They are reducing their cost as they scale. So It is again a good sign from EBITDA perspective, EBITDA margin perspective. Now the profit spike. So as we heard earlier, the profit PAT spike that was from 5.8 to 47 crores. As we discussed, it was due to the accounting effect. However, even if you ignore that, the operating profit is like still growing strongly. So okay, mid profit, net profit margins, I think. Next is balance sheet. Uh, we have discussed debt to equity. I hope you know what debt to equity is. Even if you don't know, suppose here it's 0.21. So what does this mean? This means that for every 1 rupee of your money, they have you have like you have 21 paise owed to the bank. That is like what is meant by debt to equity. So the score is good, I feel, because it has to be less than 1. Next is interest coverage. Now this is massive interest coverage ratio. It is 11.4. So what does this say? This says that they make enough profits to pay their interest bills 11 times over. Now, uh, once this is done, so it is again a good sign. I blanked out for a minute, but yeah, again this is a good sign. Now working capital. So what is concerning here is that their cash conversion cycle is around 85 days. Everybody wishes that the cash conversion cycle is negative the better, but 85 days. So they do have a lot of money tied up in their inventory actually, like all the chips and the parts. But because they have zero net debt, there is no immediate stress. So I think it will be fine. It is here. It's not this way, it is not this way, it is here. Let's move on to valuation actually. So for what I have done for valuation is that I have taken SEDEMAC and its competitors, its peers, and compared all of them. So let's talk about first the PE ratio. So SEDEMAC is around 124.9x based on 2025 earnings. So that is double the PE of its competitor Bosch India and Sona BLW. So what does it mean? You're essentially like paying for a lot of future growth today. So think of it as like buying a simple white t-shirt for around 5,000 just because it has a designer logo. So Sedemac is priced much higher than the giants like its competitors. And you aren't getting a bargain here. You're paying a, we can say, luxury price here. That's it. So it's expensive. Then after PE, there is PB ratio. So Sedemac's PB ratio is 18.9x. So most of the peers have around, we can say, between 5x to 12x. A high PB usually means that the market is valuing the company's intangible assets, especially the patents and softwares, more than the physical factories. This is something a typical thing that we can see in a deep tech company, but that adds risk of what if the technology becomes obsolete then? What will you do then? So yeah, it is high. Next is EV by EBITDA. Now, EV by EBITDA tells us that it is a score that tells us years to recover. Okay, let me explain. So, if I buy, it tells you like if I buy this whole business today, how many years of the profit will it take to pay for itself? Now, Sedimec score is 47.5. It so it would take around 47.5 years to get your money back if profit stays exactly where it is today. The To compare it with a benchmark of 25x, usually for companies making car parts or anything similar, investors want their money back in 25 years, so the price is high. But we can say that as the company has like zero net debt, mm, caution sign, but fine, I think. Next is market capital. So Sedemac is currently we can say a medium-sized fish in a very big ocean. So if their technology becomes standard for all electric vehicles in India, this fish could grow around 10 times bigger. So there is a lot of space for this company to explode in value in future. But you need to understand that whatever I am saying, the situations are many of the situations are in if. If this happens, this might happen. If this happens, this might happen. So, according to your investment needs, your investment objectives, you need to take that into consideration and see if you're willing to take this risk. If you're able to take this risk, please study your own self first and then come here and study this. Next, now there are other things that we need to consider before we end our analysis. First is any past frauds or legal cases. So the good news here is that according to RHP, there are no outstanding criminal cases or major outstanding fraud allegations against the company or its promoters or its directors. But after reading a fine print, like any other large company, we'll say large manufacturing company, they have some standard tax and civil litigations like GST or income tax disputes. These are common in India and aren't considered like a deal breaker for not investing in this company. So, yeah. Next point is GMP. So, if you are looking for a listing gain miracle where the money doubles in one day, don't hold your breath. A few days ago, the GMP was around 110, like a 8% gain, and today it has cooled down to around 28 to 70 rupees, roughly around 2.2 to 5%, we can say. Now, this tells us that market is very cautious because the IPO, obviously, GMP is not reliable. It is it is not reliable, but yeah, we can just sense the market a bit using that. Now, because the IPO price is already very high, there isn't much left for a big listing pop. So listing gains, I don't think they're going to happen. Now, big institutional investors might show interest in this, and but in the other hand, retail crowd is or might be a bit hesitant because of the price band because it is a lot for like 11 shares only. You have to like invest for 14 to 15,000. So retail investors cannot afford it. At least I cannot. So now next are sector performance. So I would say that it is a tech boom inside of a steady sector. Okay, let me explain. So even if like people are not buying like millions of scooters like last year, it's not more. The electronic inside those scooters are still increasing rapidly because of the new safety or pollution rules in 2026. The bike needs smarter brains to run. So it is a good sign. So while even if the general vehicle market is growing slowly, the auto electronic market is booming at booming? No, growing at 15 to 20% because every new vehicle sold out needs more expensive chips than the older models did. So yeah. Now this is a big red flag. Next point. Raw material risk. Now I say it is a high risk. Why? SEDEMAC, you need to understand that SEDEMAC doesn't just need plastic and metals, it needs semiconductors, the chips. So, what is the problem in 2026 is that there is currently a global memory chip shortage that is fueled by AI boom. Like companies like Google or Microsoft are buying all the chips. So, this is driving up prices by nearly around 14 to 50%. Now, since India still imports most of these chips, SEDEMAC is at the mercy of global prices and supply chains. If China stops exporting certain minerals, production could stop. So it is a very high risk, I would say. Regulatory risk, if you consider a garbage rule as a regulatory high risk or low risk, it is upon you, but it is my work to inform you. So what government says now is that if you make an electronic brain for a bike, you are responsible for recycling it 10 years later when the bike is scrapped. Now, SEDEMAC now has to pay for recycling programs and meet recycling targets, which are up to 70% in 2026. And if they fail, they might face heavy fines or could even be blacklisted from selling products. So, I think I have made you aware about all of the things, all of the red flag, green flags about this company. So, what I would say, if you're looking for a quick listing gain, like one day gain of about 50% or anything, this IPO might just disappoint you. However, if you believe that in future this company might do good, it's a high quality long term bet, but it is a bet. And if you're able to and willing to take it, take it. But it depends upon your own investment objective. So all the best. Thank you for listening to me, and I hope this was informational. If you guys like these kind of videos, please comment down so that I can make more of it. And please subscribe, like, and share my video. Until then, love you all. Bye bye.